Some analytical music fade in visuals of Federal Reserve Building. Wall Street everyday people shopping and quelling cars. Headline flash, Fed relieves rates unchanged. Inflation cools further, rate hike cycle paused. After nearly 2 years of aggressive rate hikes, the Federal Reserve is hitting pause. In a widely expected move, the Fed has decided to hold interest rates already and steady, keeping the benchmark federal funds rate at its highest level in over 2 decades. But what does the decision mean for the economy, for inflation, and for your wallet? Let's break it down. Fed Chair Jerome Powell speaking at a press conference, then graphs showing inflation trends and rate hikes from 2020 to 2025. Since March 2022, the Fed has raised rates 11 times to combat the worst inflation surge in 40 years. But now there are signs that those efforts are working. According to the latest data, inflation has cooled to 2.4%, just above the Fed's long-term 2% target. Core inflation, which includes pilot food and energy prices, is also trending downward. Meanwhile, the economy is still growing, but at a slower, more sustainable pace. Consumer spending is steady. The job market remains strong and wage growth has moderated without triggering a recession. Split screen of a family buying groceries, a small business owner, and a mortgage application being reviewed. So, by holding rates steady, the Fed is signaling something important. It's taking a wait and see approaches. Officials wanted to give the economy more time to absorb the previous hikes before deciding what's next. And for everyday Americans, the pause could bring some relief. Credit and interest rates, mortgage costs, and car loans remain high, but they are not getting worse, at least for now. Still, don't expect lower rates overnight. Powell quote on script, followed by economists analyzing trades on business news networks. Fed Chair Jerome Powell made it clear while inflation is cooling, the Fed is not ready to declare victory. We need more confidence that inflation is sustainably moving toward 2% before considering any rate cuts. Rates may stay involved well into 2025, especially if new data shows the prices picking back up. The Fed is walking a tightrope, cut too soon and inflation could roar back. Wait too long and economic growth could stall. US map with regional economic activity, then Wall Street reaction, stock triggers reacting. Market reacted causally to the decision. The S&P 500 dipped slightly as investors scaled back expectations for an yearly rate cut. But bond yields remained stable and most analysts agree the Fed is nearing the end of its tightening cycle and the worst may be over. That's especially important as the US trades toward a continental 2024 election, with both parties focusing on cost of living issues and economics messaging. Footage of people at banks, construction sites, and grocery stores. The polling data on public perceptions of the economy. For now, the Fed's steady hand is buying time and credibility. It shows the policymakers are responding to data, not pressure, and it gives businesses and consumers a bit more breathing room in plan ahead. But there's no guarantee the pause will last. If energy prices spike, global instability worsen, or wages surge again, another rate hike could be back on the table. Calm visuals of the Fed building, a family budgeting at home, and Powell walking away from a podium. The Federal Reserve decision to hold the rate steady is a turning point, not an ending. It's a sign of progress in the fight against inflation, but also a reminder that economy is still on a delicate path. What comes next depends on what the data says and how the data works reacts. Interest rate cut was ongoing, inflation outflow improving.